All right, buckle up everyone, because today we're diving headfirst into the latest IMF report.
Yeah, always a good time, right?
Well, especially this time, we're going to break down those cryptic warnings they've got in there.
It's a bit of a puzzle, isn't it?
It is. We'll figure out how it all ties back to your investments. What it means for your money. Oh, and we've got a little bonus today.
Oh, do tell.
We'll be looking at some AI stuff,
Always fun.
straight out of Iron Man, like Jarvis stuff.
Yeah.
And just to keep things interesting, a little McDonald's mystery thrown in for good measure.
Okay, you've got my attention.
So this IMF report, it's not just numbers and charts this time. They're sending out a real call to action.
Yeah, they are. It's like they're saying, hey, world leaders, things are about to get a little bumpy.
The theme itself is pretty dramatic. Policy shifts, rising threats, that's what they're calling it.
Doesn't exactly inspire confidence, does it? But it does grab your attention.
It does. So what are these big shifts they're so worried about?
Well, they've zeroed in on three main areas. Monetary policy, interest rates and all that. Fiscal policy, how governments are managing their budgets. And then structural reforms, those deep-rooted problems that need fixing.
Okay, let's unpack that. Starting with monetary policy, it seems like central banks are finally starting to cut those interest rates after wrestling with inflation for so long.
Yeah, it's a welcome change, isn't it? But the IMF, always cautious.
They always are.
They're saying, hold on a second. Inflation's still stickier than we'd like, especially for services. Like when you get a haircut, go out to eat, or need someone to fix that leaky faucet, those costs are still climbing. So central banks, they're trying to walk this tightrope.
Try not to tip the economy over.
Exactly. So what does this cautious approach mean for people like us who invest?
Yeah, what do we need to watch out for?
Keep an eye on those sectors that are super sensitive to interest rate changes. Real estate, utilities, those are often affected when rates go up or down.
Got it. So as rates come down, those sectors could become more appealing.
Exactly. Okay, now let's move on to fiscal policy. Basically, how governments are spending money and managing their debt. The IMF seems particularly concerned about the US and China.
Oh yeah, they called them out specifically, didn't they?
They did. They're basically saying, hey guys, you got to get your financial act together. They're worried that these high debt levels could really limit their ability to deal with future economic problems.
Kind of like maxing out your credit card right before a big unexpected expense.
Exactly. That's the danger the IMF is highlighting.
Okay, and lastly, structural reforms. This one always feels a bit more abstract to me. What exactly are they talking about here, and why should we care?
Structural reforms, it's about tackling those long-term issues that can really hold back economic growth. Think aging populations, outdated infrastructure, the whole shift towards cleaner energy. Not quick fixes, but super important for long-term economic health.
Okay, so what's the takeaway for investors with this one?
Well, you got to recognize the potential opportunities in those sectors focused on solving these big challenges. Renewable energy, healthcare innovation, those are areas to watch.
So it's not just about riding out the current storm, but positioning ourselves for the future.
Exactly. Now, in the middle of all these policy shifts, the IMF is also raising some red flags about potential threats that could derail global growth. They're calling them uncertainties around policy shifts and geopolitical and structural risks.
Okay, let's unpack those a bit. What specific uncertainties are they worried about?
Well, one big worry is whether interest rates will stay high longer than everyone expects.
Right, because they're still trying to get a handle on inflation.
Exactly. If central banks get it wrong and keep those rates high for too long, we could be headed for a recession. Nobody wants that.
And what about those geopolitical and structural risks? What falls under that category?
A whole bunch of things, each with the potential to shake things up globally.
Like what?
Well, take China's real estate market. It's struggling, and that's a big deal because China plays such a huge role in the world economy. Then you've got this rise in global protectionism. Countries are putting up trade barriers, like tariffs. That can really stifle trade between nations.
Right, because it makes things more expensive.
Exactly. And on top of all that, you can't forget those simmering geopolitical tensions we see around the world. Those can escalate quickly, disrupt supply chains, and lead to all sorts of market volatility and economic uncertainty.
Okay, so the global picture isn't exactly rosy right now, but you know what? There is some surprisingly good news about the U.S. economy. The IMF actually upgraded its forecasts.
Yeah, they did. That's a pretty big deal.
They're now predicting 2.5% GDP growth in the fourth quarter. What's driving that optimism?
Two main things: strong consumer spending and a boom in business investment. American consumers are still out there shopping thanks to a pretty healthy job market and wages finally growing faster than inflation.
That's a relief. It means people have more money in their pockets.
Exactly, and that keeps the economy humming. And then there's the investment boom. Businesses are putting money into expanding their operations, especially in U.S. manufacturing.
So what's driving that investment boom?
Well, partly it's government incentives like the TEPS Act, which is encouraging companies to invest in cutting-edge technology, particularly in the AI sector.
Okay, so what does all this positive U.S. news mean for investors?
Well, this strong performance, it's making the U.S. a real magnet for foreign investment, especially in U.S. stocks. It's a sign that even with all the global uncertainty, the U.S. economy is resilient and a good place for investors looking for stability and growth.
Okay, so that's good news for those of us investing in the U.S. market. But you mentioned earlier that sometimes government intervention can backfire, even with good intentions. You said we had a cautionary tale about tariffs, something about an Alabama trailer manufacturer called Pitts Enterprises.
Yeah, this is a perfect example of how even well-intentioned policies can have unintended consequences.
Okay, so what happened with Pitts Enterprises and these tariffs?
Well, back in 2018, Pitts and a few other U.S. trailer manufacturers, they were worried about competition from Chinese-made trailers. They decided to lobby the government to impose tariffs on those trailers, thinking it would protect their businesses and give them a boost.
Sounds logical enough. Protect American jobs, right?
That was the idea. And the government, they listened. They slapped some pretty hefty tariffs on those Chinese trailers, some as high as 220%. Well, those tariffs, they worked a little too well. They created a shortage of trailers in the U.S., forcing Pitts to look elsewhere to meet demand.
Okay, so they had to find a way around the tariffs. Did they manage to?
Well, Pitts started importing trailers from Vietnam. Seemed like a good solution. The problem was, those trailers, they were made with Chinese parts. And guess what? That meant they were hit with even more tariffs. The very policy designed to protect them ended up hurting them more than their Chinese competitors.
So the tariffs backfired. What was the impact on Pitts Enterprises?
It was a huge blow.
Right.
Wiped out an estimated $250 million in revenue for Pitts and forced them to halt planned investments.
Wow. So what's the lesson for investors here?
Well, this story shows how unpredictable government policies can be and how they can affect a company's bottom line. It highlights the importance of really looking closely at companies that rely heavily on government policies because those policies can shift and the results can be pretty dramatic.
That's a valuable reminder for all of us. Now let's shift gears and see what's happening with the Federal Reserve. Any news on interest rates?
We did hear recently from two key Fed officials, Mary Daly from the San Francisco Fed and Esther George from the Kansas City Fed, and their statements offer some valuable clues about what the Fed might do next.
Okay, so tell us, are more interest rate cuts likely?
Well, both Daly and George, they signaled that the Fed isn't planning on slamming on the brakes when it comes to rate cuts. They're being cautious, aiming for what they call a soft landing, bringing inflation down without triggering a recession.
So it's a delicate balancing act. What should investors be listening for in the Fed's statements?
Pay attention to the specific language they use. When you hear words like gradual, normal, steady, that usually signals smaller incremental rate cuts, probably around 25 basis points. It means the Fed doesn't see any major economic storms brewing on the horizon, at least for now.
Well, that's good to hear. Now, for something completely different, let's talk about a really cool breakthrough in artificial intelligence. And this one, it's almost like something out of Iron Man. We're talking AI that can actually interact with computer screens.
It's pretty amazing, isn't it? Anthropic, an AI company that's backed by Amazon, they've developed this system that can actually interact with computer screens just like a human. It can click icons, type, and even do more complex tasks.
Hold on. Are we talking about Jarvis here? This is incredible. What does it mean for investors?
It's a potential game changer for a lot of industries. Think about the possibilities for automating tasks, boosting efficiency, and saving money in sectors like customer service, finance, even healthcare.
Wow, this really could revolutionize how we work. This AI development, it could spark a whole new wave of investment opportunities, right? Where should we be looking?
Definitely keep an eye on those companies developing and using this AI tech. Software companies, cloud computing providers, and businesses in sectors ripe for automation, like logistics and manufacturing. Those early adopters and innovators, they're likely to see some big growth in the coming years.
So Jarvis is coming to a business near you, and smart investors should be ready to ride that wave. But let's bring things back down to earth for a moment with a story that might make you think twice about your next fast food run. We're talking about McDonald's and a bit of a food safety scare that's been in the news lately.
This story really highlights how important it is to consider risks that go beyond just the numbers when you're evaluating investments. Even those big, seemingly stable companies like McDonald's, they can face unexpected challenges that can hit their bottom line hard.
So what happened? Give us the details.
Well, there's been this outbreak of E. coli linked to McDonald's Quarter Pounder burgers. The CDC is investigating. So far, there have been 49 reported cases across 10 states, mostly in the Rocky Mountain region. 10 people have been hospitalized, and sadly, one person has died.
Oh, that's terrible. I
Yeah.
imagine this isn't good news for McDonald's stock price.
You're right. The news sent their stock down 9% in after-hours trading. That's a big hit to their market value, and it really shows how interconnected various risks can be.
What are the key takeaways for investors from this situation?
This whole situation really underscores the importance of diversifying your portfolio. Don't put all your eggs in one basket, even if it seems like a safe, solid blue chip company. Unexpected events happen, and it's crucial to be prepared for those risks.
A sobering thought, but a good reminder for all of us. So we've covered a lot of ground today. Global economic trends, AI breakthroughs, even a cautionary tale about McDonald's. Lots to think about, and I'm sure our listeners have questions.
They probably do. And we'll be digging deeper into those questions in the next part of our deep dive. We'll be exploring how to navigate this complex economic landscape and find those potential investment opportunities amidst all the uncertainty.
Stay tuned for more in part 2.
Welcome back, everyone. So last time, we explored some pretty big shifts happening in the global economy, remember? Especially those highlighted in that IMF report.
Oh yeah, that was a doozy.
And we touched on that mind-blowing AI development that could change how we work. And of course, who could forget that McDonald's food scare, a reminder that even giants aren't immune to risk.
It was a lot to take in, for sure. But that's what we're here for, right? To help make sense of it all. And most importantly, to understand how it affects you, our listeners.
Exactly. Today's deep dive is all about those aha moments. Those moments that help you make smarter decisions, whether it's about your personal finances or potential investment opportunities.
Speaking of that IMF report, one of the big takeaways was all that emphasis on uncertainty. It really feels like the global economy is at a crossroads, with so many different paths forward, each one with its own risks and rewards.
Absolutely. And a lot of that uncertainty boils down to those policy shifts we discussed, right? Monetary policy, fiscal policy, and those structural reforms. How governments and central banks navigate all of that will have a huge impact across the globe.
Okay, so let's start with monetary policy. The Fed is hinting at more interest rate cuts, but they're being super cautious. How can we, as investors, try to anticipate their next move? What should we be looking for?
Imagine the Fed like a chess player, planning their moves based on all this complex economic data. It's like a giant chessboard. The key is learning to read that board, just like the Fed does.
Okay, so we need to become economic detectives. Where do we even begin?
It starts with paying close attention to those economic data releases, especially the ones related to inflation and employment. Those are the metrics that the Fed really focuses on,
Why those two specifically?
because they give the Fed those crucial insights into the health of the economy. Rising inflation, well, that could signal they need to raise interest rates to cool things down. But if unemployment's rising, that might suggest they need to lower rates to boost growth.
It's like they're always walking this tightrope, aren't they?
Exactly. So it's not just about reading headlines, but understanding the data behind them. For example, you see a report showing strong job growth, but also a sudden spike in inflation. Well, that's a mixed signal, right? That might make the Fed hesitant to cut rates further.
Got it. So we can't just rely on gut feelings. We need to be data-savvy investors.
Exactly. And don't forget the power of language. The Fed is very deliberate with the words they choose.
You mentioned some keywords last time. Gradual, normal, and steady. What should we be listening for now?
Keep your ears peeled for any shifts in tone. If they start using words like aggressive or concerning when they talk about inflation, that could signal they might be changing their approach to interest rates.
Right, because language can have a big impact on market sentiment.
Right.
Right.
Absolutely. Understanding how the market reacts, how it's influenced by things like the Fed's words, that's crucial for making smart investment decisions.
Okay, we've covered monetary policy. What about fiscal policy? The IMF seemed pretty worried about all that rising government debt, especially in the US and China. What could that mean for investors?
Think of government debt like a weight dragging down an economy. The more debt there is, the slower and more difficult it becomes for the economy to grow.
So if a country is drowning in debt, that's going to impact its overall performance.
Exactly. And for investors, it means you need to be cautious about putting your money in countries with really high, unsustainable debt levels. Their economies are more vulnerable, and their currencies could weaken.
So it's not just about looking at a company's numbers, but also checking the economic health of the country where it operates.
You got it. Think of it like building a house. You need a strong foundation to hold everything else up. Okay, now let's tackle structural reforms. I admit this one's still a bit fuzzy for me. Why should investors care about this? Think of structural reforms like those big renovations you need to do to keep your house modern and functional. It's about tackling those deep-rooted issues we talked about: aging populations, outdated infrastructure, barriers to innovation. It's complex, but those challenges also create some exciting investment opportunities.
Okay, give me some examples. What sectors actually benefit from these reforms?
Imagine a country investing heavily in green energy infrastructure. That opens up opportunities for companies involved in solar, wind power, and other clean technologies. Or if a government tries to push digitalization, that's good news for companies in e-commerce, fintech, and even cybersecurity.
So it's about spotting those sectors that align with a country's long-term economic goals.
Exactly. Structural reforms are often a good indicator of where future growth will come from. For investors, it's about recognizing those signals and getting ahead of the curve.
That makes a lot of sense. Now let's shift gears to something that's both incredibly exciting and maybe a little scary. Artificial intelligence. Remember that AI breakthrough from Anthropic, the one that can interact with computer screens just like a human?
Yeah, that one blew my mind.
Mine too. What are the real-world implications of this tech? Are we already seeing it being used?
We're just at the beginning of this AI revolution, but the potential applications are mind-boggling. Imagine an AI assistant that can handle your emails, schedule meetings, and even write documents for you. Or think about AI-powered customer service chatbots that are available 24/7.
So we're talking about huge improvements in efficiency and productivity.
Exactly. And it's already being used in areas like healthcare, finance, and manufacturing. In healthcare, AI is analyzing medical images, helping with diagnoses, and even personalizing treatment plans. In finance, it's being used to fight fraud, manage risk, and give personalized investment advice. And in manufacturing, AI is streamlining production, improving quality control, even designing new products.
It's hard to grasp how fast this technology is changing things, but it makes you wonder about the future of work. If AI can do all of this, what happens to human jobs?
That's the question, isn't it? While it's true that some jobs will inevitably be replaced by I think it will also create new opportunities we can't even imagine yet.
So it's not about AI versus humans, but more about humans and AI working together.
Exactly. Think of it as a collaboration. AI can handle those repetitive, data-heavy tasks, which frees up humans to focus on the things that require creativity, critical thinking, and emotional intelligence.
So the key is to adapt, to learn those new skills that complement AI's abilities.
You got it. The future of work will be all about finding ways to leverage the strengths of both humans and AI to create a more efficient and innovative society.
It's exciting, but also a little daunting, wouldn't you say? That feels like we're on the verge of a whole new era.
We are. And while there will definitely be challenges along the way, I truly believe the potential benefits of AI are enormous. It has the power to make our lives better in countless ways, from healthcare to education to how we work and connect with each other.
Well, that's a more optimistic outlook than I was expecting. But let's not forget about those potential risks the IMF highlighted. Things like China's real estate struggles, the rise in global protectionism, and those geopolitical tensions brewing around the world. These could really shake things up globally and impact our investment decisions.
You're absolutely right. It's crucial to stay informed about those risks and factor them into your investment strategy. Let's break down each one, starting with China's real estate situation.
Okay, remind us why this is such a big deal, even for those of us not investing in China.
Well, China's real estate market is absolutely massive. It makes up about 30% of their entire economy. So when it starts to falter, the impact is felt globally.
So it's like a domino effect, right?
Mhm.
What could this mean for the world economy?
A slowdown in China's real estate market could trigger a chain reaction, impacting everything from the price of raw materials to global supply chains. It can even shake investor confidence worldwide.
Okay, so how should investors approach this risk? What should we be watching for?
Keep a close eye on how things are developing in China's real estate sector and how it's impacting global markets. Pay attention to news about property prices, construction activity, and the financial health of those big real estate developers. And be prepared for some potential volatility in sectors that rely heavily on Chinese demand. Think things like commodities and manufacturing.
So it's all about staying informed and adjusting your investment strategy as needed.
Exactly. Now, let's talk about that rise in global protectionism. We've already seen how tariffs can backfire, like with the Pitts Enterprises example. What are the broader implications for investors? Why should we be concerned about this trend?
Well, history has shown us time and again that those protectionist policies tend to hurt everyone involved in the long run. They can lead to higher prices for consumers, less efficiency, and slower economic growth overall.
You're exactly right. And from an investment standpoint, protectionism creates a lot of uncertainty and disrupts global trade, making it harder for businesses to operate smoothly and profitably.
Okay, so what's the takeaway for investors here?
Be cautious about investing in companies that are heavily exposed to global trade tensions. These companies could face higher costs, reduced demand, and increased competition because of these protectionist policies. Diversifying your portfolio can help mitigate those risks and stay informed about any trade developments that could impact your investments.
Sound advice. Now, let's talk about the big elephant in the room, all those heightened geopolitical tensions. We're seeing conflicts and instability in various parts of the world, and it's hard to ignore how that might impact the global economy.
You're absolutely right. Geopolitical risks are a major concern for investors because they can create a lot of volatility and uncertainty in the markets. Think about how conflicts can disrupt supply chains, drive up energy prices, and even lead to capital flight as investors seek safer havens for their money.
So in this kind of turbulent environment, how do we as investors navigate all of this?
It's all about staying informed, assessing the potential impact of those geopolitical events on your investments, and being flexible enough to adjust your strategy as needed.
That sounds like a lot to keep up with. Any tips on how to stay on top of everything?
Absolutely. Stay informed by reading reliable news sources, following those expert analyses, and trying to understand the geopolitical forces at play in different regions of the world. It can be a lot, but it's worth the effort.
This makes me realize that being a good investor today means you need to understand more than just finance. You need to grasp economics, geopolitics, and even technology. It's a lot.
You're absolutely right. Investing in today's world, which is so complex and interconnected, requires that broader perspective.
Okay, so we've talked about the potential downsides of these global risks. Are there any potential upsides for investors? Can we turn these challenges into opportunities?
Of course. Remember, every crisis presents opportunities for those who are prepared and know where to look. Let's take geopolitical tensions as an example. If a conflict disrupts the supply chain for a particular commodity, well, that could create opportunities for companies in other regions that produce that same commodity.
So it's about finding those companies and sectors that stand to benefit from shifts in the geopolitical landscape.
Exactly. Think of it like a game of chess. You have to anticipate your opponent's moves and position yourself accordingly.
I like that analogy. Now let's dive into the world of NFTs. These digital assets have exploded in popularity, but honestly, they're still a bit of a mystery to a lot of people, even me. Can you help us understand what they are and why they've become so valuable?
Absolutely. NFTs, or non-fungible tokens, are unique digital assets that are verified and tracked using blockchain technology.
Okay, but what does that actually mean? What are you actually buying when you purchase an NFT?
You're buying the original verified version of a digital item. It could be anything from a digital artwork to a music track to a virtual item in a video game. Think of it like owning the original Mona Lisa versus just a print. The NFT proves you own the authentic version.
So it's about digital ownership and scarcity? But why are people willing to pay so much for them? What's driving their value?
There are a few things at play. Part of it is speculation, people buying NFTs hoping their value will skyrocket and they can sell them for a big profit. But there's also a growing belief that NFTs represent a new kind of ownership in the digital world, especially as the metaverse keeps developing.
So it's like betting on the future of the digital economy.
Exactly. Some people believe that NFTs are the foundation of a whole new digital world where ownership and value are defined in completely new ways.
It's a fascinating concept, even if it's still hard to wrap your head around. But tell me, are NFTs a legitimate investment or are they just a passing fad?
That's the million-dollar question, isn't it? There's no easy answer. Like any emerging asset class, NFTs are volatile and risky. But they also have the potential to disrupt existing industries and create entirely new markets.
So it's a high-risk, high-reward situation.
Exactly. Just like any investment, it's crucial to do your research, understand the risks involved, and only invest what you can afford to lose.
That's good advice for any investment, really. Now, I want to bring up the McDonald's food safety scare again. It really showed us how even those big, seemingly stable companies can face unexpected challenges that can directly impact their profits.
You're right. It highlights the importance of considering those non-financial risks when you're evaluating your investments.
What are some other examples of non-financial risks that investors need to be aware of?
There are many, and they can be different depending on the industry and the specific company you're looking at. Some common ones include reputational risk. A company's reputation can be damaged by things like product recalls, data breaches, or ethical scandals.
Right, because a company's reputation can be ruined almost instantly.
Exactly. Then you have regulatory risk. Changes in laws and regulations can have a huge impact on how a company operates and how profitable they are.
Okay, so what about environmental risk?
That's a big one. Companies that pollute or contribute to climate change could face fines, lawsuits, and even consumer boycotts.
And social risk?
That's about how a company handles social issues, things like diversity and inclusion or fair labor practices. Companies that fail to address these issues could face backlash, damage to their reputation, and struggle to attract and keep good employees.
So it's not just about looking at the numbers. Investors have to go deeper, look beyond the financials, and really assess those broader risks that could affect a company's long-term sustainability.
Precisely. A smart investor looks at both the financial and non-financial factors.
Well, that's a lot to think about. We've covered a lot of ground in this episode. Global economic trends, AI breakthroughs, the world of NFTs. But we're not done yet. In the next part, we'll explore some practical strategies to navigate this complex landscape and find those potential investment opportunities amidst all the uncertainty.
Stay tuned for more in part 3 of our deep dive.
And we're back for the final leg of our deep dive. It's been quite a journey, hasn't it? Global economics, AI, even the wild world of NFTs.
We've certainly covered a lot of ground, unearthing those hidden trends that can really shape your financial decisions. Remember those IMF warnings and those tariffs that backfired on Pitt's enterprises. It's all connected.
It is. But, knowledge is only powerful when you put it into action. So in this last part, let's get practical. What can our listeners actually do with all this information?
Let's turn those insights into strategies. With all these changes and potential risks, how can our listeners navigate this economic landscape and protect their hard-earned money?
That's the million-dollar question. First things first, how should we even be thinking about investing right now? The IMF report was a bit cautious about the global outlook, but the U.S. economy seems to be chugging along. What's the right approach?
I think the key is balance. Don't let fear paralyze you, but don't be reckless either. And remember, diversification is your best friend in uncertain times.
Don't put all your eggs in one basket, right? That's what they always say.
Exactly. Spread your investments across different asset classes, industries, even geographic regions. It helps reduce risk and opens up more opportunities to capture growth wherever it pops up.
Okay, that makes sense. But with so many options, where do we even begin? How do you actually build a diversified portfolio? What should we be looking at right now?
One approach that a lot of people find helpful is the core satellite strategy.
Core satellite. Okay, I'm intrigued. Tell me more.
Imagine it like building a solar system. Your core portfolio is like the sun. It's made up of those stable, low-risk investments, index funds, bonds, things like that. They're the solid foundation of your portfolio. Then you have your satellite investments. Those are like the planets orbiting the sun. They're your more targeted investments, maybe a bit higher risk. Specific sectors or companies that you think have a lot of potential for growth.
So the core provides stability, and the satellites, those are the ones with the potential for those big wins.
Exactly. It's about balancing risk and reward and making sure your investments are aligned with your financial goals and how much risk you're comfortable with.
That's a really helpful analogy. I can picture it now. But with all these risks swirling around inflation, geopolitical tensions, you name it, are there any safe havens investors should be considering right now?
When things get uncertain, investors often turn to those so-called safe havens, assets that tend to hold their value or even go up when the market takes a dip. Gold is a classic example. It's been a store of value for centuries, and it can help protect you against inflation and economic uncertainty.
So adding a little gold to your portfolio could be like an insurance policy during those turbulent times.
You can think of it that way. Another option is U.S. Treasury bonds. They're considered pretty safe because they're backed by the U.S. government.
Got it. So those are some good options to consider. But what about those sectors we talked about earlier? Those ones that are expected to grow because of structural reforms, like renewable energy and healthcare. Are those still good bets?
Definitely. Those long-term trends, the shift to green energy and the growing demand for healthcare, those aren't going away anytime soon. A little economic turbulence isn't going to derail them.
So these are investments that could be both profitable and make a positive impact on the world. That's a win-win.
Absolutely. And as more and more countries invest in these areas, we're likely to see even more opportunities for companies operating in those sectors.
Now, we can't wrap up this conversation without talking about that AI development from Anthropic, that one that can interact with computer screens just like a human. It's early days, but it seems like this technology could completely transform entire industries. How can investors get in on the action? How do we capitalize on this AI revolution?
There are a couple of approaches you could take. One is to invest directly in those companies developing and implementing this AI technology. Software companies, cloud computing providers, businesses that are ripe for automation. Think things like logistics and manufacturing. Those are good places to start.
So it's about identifying the companies that are really leading the way in AI.
Exactly. Another option is to look at thematic ETFs that focus on artificial intelligence. These ETFs give you exposure to a whole basket of companies involved in different aspects of AI. So it's a way to diversify your investment within that sector.
That's a great option for investors who want to be a part of the AI boom, but don't necessarily want to pick individual stocks. Now, before we say goodbye, let's circle back to those non-financial risks we talked about earlier. That McDonald's food safety issue was a real wake-up call. It showed us that those risks can have a huge impact, even on those big, well-established companies. How can investors really get a handle on these kinds of risks? How do we even begin to assess and manage them?
Non-financial risks, they can be tricky. They're often harder to measure than those traditional financial risks, but they can be just as damaging, maybe even more so.
I mean, a company's reputation can be destroyed practically overnight.
Absolutely. So how do you assess those less tangible risks? Start with research. Look into the company's track record on things like environmental practices, their social responsibility initiatives, how they govern themselves. Look for any red flags, lawsuits, fines, negative news coverage, things like that.
So it's about doing your due diligence, really understanding the company's values and how they operate.
You got it. And don't be afraid to engage directly with the company. Attend shareholder meetings, contact their investor relations department, ask questions about how they're managing these risks.
That's a really proactive approach. It makes you feel like you're more involved and that your investments align with your personal values.
Exactly. Remember, investing isn't just about chasing the highest returns. It's also about supporting companies that are operating ethically and responsibly.
Well said. So as we wrap up this deep dive, what's the one key takeaway you want our listeners to remember?
The global economy, it's a complex and ever-changing landscape. There are challenges, but also opportunities. The key to success is staying informed, being adaptable, and making those thoughtful decisions based on a full understanding of all those factors, both financial and non-financial.
That's a fantastic way to put it. Knowledge is power, and I hope our deep dive has given you the insights and tools you need to navigate this dynamic world and achieve your financial goals.
Investing is a journey, not a sprint. Stay curious, stay informed, and never stop learning.
And maybe think twice before that next quarter pounder.
A salad might be a better choice. Until next time, happy investing, everyone!